Hello and welcome to All Things Money. My name is David Blain, and during today's segment, we're going to finish up our discussion on oil prices worldwide with the tensions in the Middle East, with Libya and the departure of the Egyptian president. There's been a lot of focus on the price of oil recently, so we thought we'd devote an entire show today to oil and its implications for you as a consumer and an investor. If you missed the first two segments, you can visit us on the web, www.dlblain.com. There you'll find archived copies of the show. You can also email us at allthingsmoney@dlblain.com. And feel free to give us a call during normal business hours. Our phone number is 252-633-0107. So far we've recapped some of the world's top petroleum producers, which the U.S. is number 3, as well as top consumers, where the U.S. is the number 1 consumer, although reducing our consumption. China is the number 2 consumer in the world, and they are increasing their consumption. And we talked about the implication of rising crude prices are actually good for the development of alternative fuels, because as the price of oil gets higher, people will find it economically viable to do other things. And I'm not for this because I believe that the free market should set the prices, but there are actually some politicians that have been proposing huge taxes on oil to make the price so high that you're almost forced to look for alternative energy sources. And once again, I'm not for artificially raising the price of oil. I think that it's something that will happen in and amongst itself. As the price of oil continues to rise, alternative energy will become more economically viable. Kind of a little personal story. I had a house that was heated with propane when I bought it. And this, no offense to the propane producers out there, but propane is very expensive to heat your house. Well, we put in a geothermal system which extracts heating and cooling from below the earth, below the surface of the earth. The temperature is relatively constant, and so the geothermal system uses the heat or cooling of the earth, and it uses no fossil fuel whatsoever to heat and cool your home. The only thing that it needs is a small amount of electricity to run the blower fan, but it uses no fossil fuel whatsoever. Well, the system's very expensive, but when compared to propane, my payback period was going to be about 3 to 5 years, and so it makes economic sense. You're going to do the same thing with all other types of energy, such as a car. Right now, the hybrid technology is just not there in terms of payback period. On emissions, sure, but in fuel economy, that's not the case. There are diesel and other types of cars that can get just as good a gas mileage. But anyway, so let's move on to, we were talking before the break about the implication of oil prices on investing. And energy stocks cue off the rate of change of oil prices, not necessarily the level. So whether it's $70 a barrel or $140 a barrel is not the most important thing. What's the most important thing for energy stocks is the rate and direction of change. And what I mean by that is, if energy prices are increasing rapidly, you can expect that energy stock prices are going to go up. In fact, we see here, looking since 1984, the correlation between the energy sector annual change and the crude oil futures percent change is about 0.74. What that means is that the change in energy prices, about 75% of the change in energy prices can be explained by the change in crude oil prices. And so if you're looking at the energy sector, you want to be looking at the rate of change of the energy of crude oil futures. Now, the energy sector is not a homogeneous sector by any means, and so you have to look further. Those statistics that I was using are what's called an equal weighted industry. Typically, indexes are capitalization weighted, but if you look at equal weighted, that's the data. So if you look at the different industry, things like coal falls under energy, drillers, equipment and services, exploration and production, integrated oil companies like Exxon. You've got storage and transportation, and refining and marketing. And we see that when oil prices are rising, equipment and service, exploration and production, and drilling stocks typically do best, that their sensitivity to the price of oil is the highest. And so when you see the price of oil rising, they typically do the best. Storage and transportation, integrated, and refiners often lag. So when the price of oil is rising rapidly, if this pattern holds correctly, you would want to invest in the exploration production, the equipment and service, and the drillers, and not necessarily the integrated, the refiners, and the transportation. Now, this is not to say that those companies are not going to benefit from the rise in prices. It's just that they're not as dependent. So, for example, refiners are the least sensitive to the price of oil because essentially you have this canceling out effect, that higher oil prices are a sign of increasing demand. People demand it more, and so they're willing to pay more. But in refiners, that demand is increased. It is met by an increase in the price of the oil itself going into the process, because refiners are the ones that take the crude oil and turn it into some type of refined product such as gasoline, and so they typically get squeezed when the price of oil goes up. For refiners to make money, the products they produce, such as gasoline, the heating oil, the diesel, they have to rise at a faster pace than the input cost, which is crude. And so the people that sell to the consumers, which, by the way, this is called the crack spread, the difference for refiners. But typically the price of gasoline does not rise as fast as the price of oil. The people that sell to the consumer are reluctant to keep raising the price very fast. And so refiners in the middle, they tend to get squeezed. They can't typically raise the price of their output as fast as the price of the input, which is the crude oil. So, in summary, when looking at the rise in oil prices, what we want to look at is the rate of ascent, not necessarily the level. And different energy companies are affected in different manner. The equipment and services and drilling stocks are affected the most, and refiners the least. Well, that's all the time we have for today's show. I hope that you join us next week, where we'll continue our discussion about all things money. For our David Blain, this is All Things Money.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.